Pope Gregory XIII, the Julian calendar and an inconvenient leap year. The connection? Well, the reasons are tax year ends today, the 5th of April. It means that in addition to the sugar tax, there are a number of other important changes for business and all of us coming tomorrow. Not least Scotland's own rates of income tax and changes to personal allowances elsewhere. Well, Patricia Mock from Deloitte's Tax Policy Unit and Rebecca Redding, Tax Director at PwC, are here to help talk us through them. So good evening to you both. Rebecca, let me start with you. What are the main things that businesses have got to look out for?
Well, in a way, it's quite good news for business because we don't have a lot of major changes coming up this April. Last year, we had loads of things. There were changes to losses, there were changes to deductions of finance costs. But this year, we've got the same tax rate, still at 19%. The government have talked about lowering the rate to 17%, but that's not till 2020. So for the main corporate rules, it's very much business as usual.
What do you think on the personal tax front, Patricia? I guess the sort of headline grabber is this extra tax ban we're getting in Scotland.
Well, that's right, yes. The Scottish Government can select their own rates and bans for earnings, not for savings and dividends income. And certainly last year, their higher rate threshold was a bit lower than that in the rest of the UK. But this year, we've got this really quite complicated system. So the same personal allowance, then there's a 19% rate for £2,000. There's then a 20% rate for about 10,000, then a 21% rate, 41% rate, 46% rate. So by and large, all higher than in the UK. So the people who will gain from this will be the lower earners. People earning less than about 26,000 are better off than if they lived in the UK.
Oh, God, that sounds like Rebecca. It sounds like, I mean, if you're an employer and you've got operations in Scotland as well as the rest of the UK, that's a real headache for your payroll, isn't it?
It just goes to show that lots of good ideas that come out when politicians think of taxing the way tax system should work do cause a lot of complexity, and sometimes a lot of people who aren't on very high incomes can be significantly affected.
Now, one of the other things that's happening tomorrow, the minimum employer contribution for auto-enrolment pension schemes, that's doubling. Is that going to be a headache for employers?
I think most employers are prepared for these kind of changes. Auto-enrolment has been something that's been on the cards for many years. We'd like to think that everybody knew this was coming and had thought about how it might be affecting them. Like a lot of measures now, you do get quite a lot of lead time, which is a good thing.
Of course, Patricia, the flip side of this is that employee contributions are also rising. So people who are auto-enrolled are going to notice a drop in their take-home pay next month, aren't they?
Mm-hmm. That's absolutely right, yes. And may not be expecting that.
Yeah.
So employers may well be prepared, but I don't think employees will be.
However, on the plus side, for most people, the the personal allowance rises.
The personal allowance rises, yes, by not the leaps and bounds that we've had in the past few years. It just goes up by 3% CPI inflation, so up from 11,500 to 11,850. And the higher rate threshold goes up as well to 46,350.
But the top rate, that stays at 150, so a lot of people get dragged into that top rate of income tax, potentially.
Yes, more and more people get dragged into that, and some other changes as well are meaning that more people might get dragged in than they would otherwise.
Now, one change, Rebecca, that affects both businesses and savers is that the cut in the amount of dividends that you can receive before you start paying taxes on them comes down. That's a real hit for small business owners, isn't it?
Yeah, so we've had a £5,000 exemption for dividends for a few years now. It was a year ago, roughly, last year's budget, when the Chancellor announced he'd be cutting that to 2. Very unpopular measure from small business owners, but obviously lots of people do receive small amounts of dividend income that will still be covered even if the rate's gone down. So if you're running your own business, at least again you've had a year to think about how this might affect you.
Yeah, I guess if you're a saver, Patricia, then 5,000 to 2,000, a lot of people won't even get 2,000, will they, I guess?
Well, it depends on their portfolio, I guess. But I think the main people affected by this, as Rebecca says, will be the people who've set up to work through a company and planning to pay themselves partly salary and partly dividend.
Yeah.
And they may have done that on the basis they were expecting a £5,000 exemption, and now they're getting 2,000.
And a good bit of news for pension savers: for the first time in years, a rise in the lifetime allowance.
Yes. There's another area of complexity. There is a rise in the lifetime allowance, again by 3% CPI, so it's gone up to £1,030,000. But of course there are lots of other restrictions in pension savings allowances, so people need to monitor their overall savings against that, but the annual allowance has not gone up. That's still 40,000, and for higher earnings, of course, that's now tapered down to 10,000.
Yeah, horrible situation.
A lot of complexity, for sure.
All right, well, I guess that complexity keeps you both in business, doesn't it? Patricia Mock, Rebecca Redding, thanks both, good to see you.